Just to kick off the session, I think in the first half of the conference, we heard a lot being spoken about India's journey towards becoming a leading electric mobility nation. And when people talk about early adopters, China, US, Western Europe always comes up. And when we look at some of those developed markets and the way they have evolved, I think apart from a conducive government regulatory framework and a very vibrant ecosystem in general, including a robust infrastructure, a common theme across those markets were also access to capital for the market participants. And I think that's a very critical determinant in establishing how quickly and smoothly an industry in a nascent stage like electric vehicles would shape up. So this session is designed to evaluate some aspects around that. Before I get into the Q&A, let me just lay out the format that we are going to follow. So we will have a 45-minute Q&A where we will evaluate some of the themes around EV investing, hear thoughts from both market participants as well as investors, and then we will open up the floor for around 15 minutes for any Q&A that we might have. So the first question is to Rajesh, and we have heard a lot about the EV trajectory from market participants. It would be good to hear, Rajesh, from you what the investment community is seeing. You have evaluated multiple businesses in the EV landscape, and what are the promising factors, what are the dampening factors that an investor feels is prevalent in the Indian EV ecosystem today?
Yeah. No, so if I see the current system in terms of where the development is happening, and to some extent I like to go back to history of what I've seen way back in 2008, and at that point in time also there was a lot of euphoria about EVs, but unfortunately Reva was the only company in India which was doing EVs. So there was no ecosystem, be it in terms of suppliers, even the government policies, except for Delhi coming forward to give some subsidies and MNRE supporting to some extent. Not much of discussion were happening around EVs because the whole thought process was oil price being high and the peak oil theory and all being discussed. So people thought EV will be the solution to the panacea of oil. So that's how it went on. But if I see the system now, which is 10 years later, the number of companies which are kind of looking at starting up, or those which have started and built over the last few years, based on what we have seen globally, as be it in the US or Europe or China, I would say the ecosystem is building up well. There are different types of companies, which right from component manufacturers to drivetrain manufacturers to OEMs, and also in some way even service providers using the EV ecosystem is starting to come up. So there are enough number of companies within India I'm talking about, which are coming up, and I've spent some time meeting some of these companies. It's pretty interesting to see how each one is thinking and trying to develop the thought process around business. While that is a positive sign, at least from the way we look at things, we are a growth stage investor. So to some extent, these are still early stage companies for us. Still, many of them are still to find the product market fit and the eventual unit economics to kind of stand out. I would think, based on my study of the system ecosystem today, the price parity of a electric vehicle for a end consumer, and I'm again trying to differentiate between a B2C play and a B2B play. When I say B2B play, is more the equivalent of ride sharing and those kind of solutions. The end consumer play, the price parity with the IC is not reached out. It would take some more time if you avoid without any subsidies. I'm talking about, because subsidies is still a play which is there today. So I would say it's going in the right direction. Probably it'll be another 18-24 months before we see good opportunities for players like us to kind of to invest a reasonable amount of capital in the EV ecosystem.
Right. Vignesh, your thoughts on the same? You are now invested into the space. So, I mean, how do you see the landscape evolving?
So we also take a little bit of a bet ahead of time, but smaller ticket size, which enables us to learn about what's going on. Now, there's a lot of points that panelists had made this morning. I'd like to add 2-3 interesting nuances that we feel India can bet on. Right. One is that when I've met a lot of the entrepreneurs, as Rajesh mentioned, there's so many people starting up. Just the vibrancy of talent, and coupled with even within large organizations, say like a Hero Electric, right? The vibrancy of ideas that they are evaluating, and the pace at which they're trying to test out something, come out with the next release. We believe that when we see all of this, there's enough to take a bet that India, all the policies, etc. aside, just from a talent and a DNA to bring out some of the best EV capabilities in the world, India is probably placed on par, right? Earlier, we'd always think of India as a market which would be a great follower in technology. Right? While we are still behind on the EV adoption curve, I think just in terms of how the use cases are coming out, what people are thinking about, what's the right product market fit here, how would it be delivered, how would it be financed, I think there's enough number of people who are applying ideas and thoughts that are pretty much at par with what we are seeing across the world. The second interesting thing that we see is that not everybody is stuck with saying, let me go out there with a huge bang. Right? People are also saying, can I find areas where there's adoption and then I gradually increase the space? Which is interesting because that also allows for a certain frugality of development that is a very Indian DNA. It also allows for people to make mistakes that are less expensive and therefore can correct and come better. Right? So I think these are some of the encouraging pieces. You talked about what are the speed bumps along the road. I think the question is not, one is the speed bumps, but where we see some of the risks is getting way too ahead of ourselves, saying, today is the day, the D-Day has arrived, that everything is going to change electric. I think that's the wrong way to approach it. I think the way to approach it is to say, when it starts making sense, a bit like UPI, if I may use the analogy, I think the UPI interface is one of the best financial payment interfaces across the world. The day, a car repair mechanic actually starts finding it easy to use UPI, you can tell that the entire financial system has changed the way you think about cash payments. So I think we'll have to work towards that when it becomes an accessible product, but it'll have to go through its stages, and any technology has to mature through putting millions of miles on the road. So I think we should be careful of getting too ahead of ourselves in that sense.
Interesting. Sohinder, my next question is for you. You have successfully navigated through multiple rounds of fundraisers. Let me flip the question around. What have you heard? And you can be dispassionate and give the views that you've heard from the investors and not your views. What have you heard from the investors that typically are negative in nature in terms of the industry not picking up? And what are some of the things where you are at par with them, where things are positive and the industry will grow?
Not negative or positives, but I would say challenges or some sort of positiveness that they bring in terms of enablers. Right? My experience with the investors has been mostly that they have been more on the positive side. They have been pragmatic and they have been patient and perseverance. But somewhere down the line, one has to decide. There are two pulls happening here. Generally, in an owner-driven organization, there is a bottom line push always. Reduce your losses, mitigate losses, yet grow. And when the investor comes, the first and foremost is market access, top line growth, yet trying to hold on to bottom line. So that's a classic divide between what was happening and what is happening. And that pulls the organization into two directions. And that's where the critical balance is required. And that is where the investors' demands as well as the owner-director's demands have to be met somehow, and creating a synergy or a meeting point somewhere. So the most critical time is a breaking in type of a thing, like after the honeymooning period. The reality dawns on both sides. And that's where the role of the organization, the role of the management is so important to see to it that there are no dichotomies into the system, and there is a synergy into whatever we do. The second thing that happens over here is more of an enabler, where when the investor comes, he gets so much of an outside focus that I think from the day one, or perhaps down the line few months, they start thinking of how to exit, or when to have a second round, when to increase the exposure. In the process, they enable the organization in a big way on the statutory and mandatory requirements of the organization. Perhaps the organizations become squeaky clean, even if they were clean, after the investor comes in. So that's a big enabler for the organization. Because, for example, we would have been doing something like 20 type of statutory obligations fulfilled. They added another 40 when they came. Some of them were unheard of. And we landed up in a very good, ready to sort of invest organization for the second round because of that. Then there are challenges of the investors who have come with the preset notions of what can happen to this organization where they are investing, especially like people like, for us, Hero Electric. They think that we have a brand, we have already some deep pockets, and we have products, and we have a market access, we have network. What else is missing? You just missed a little bit of icing on the cake in terms of lump sum money, which we are giving you. Now, where is the growth? Why? Because there is so much happening on the peripheral, on the horizon, that it is very difficult for them to fathom the realities on the ground. So the next challenge comes in the board meetings, where the chemistry has to match to the realities of the ground. And that takes a lot of time for 3, 4, 5, 6 meetings before their aggressiveness or assertiveness and the practicality of business match somewhere where the unison starts. Or if it doesn't start, it is a hell of a work for both of us. But in our case, I would believe that our investors particularly have been very, very pragmatic, very practical. They easily saw that it is a long term, it's not a 2 or 3 years type of a game. It's something like 6 to 10 years type of a window. They are patient, they are perseverance, and we are reaping the fruit of that.
Great. Just building up on that, Sohinder, are there, some decisions where the medium-term goal of the investor versus the long-term goal of the organization are somewhat at conflict? We see that, especially in early stage industries where you can either, build up the business for a 20, 30 year kind of a future, or have a 5 to 7 year exit on your mind. And sometimes these two objectives do clash. Are there areas where
not sometimes, I say many a times. Why? Because it's very clear. The focus of investors is not more than 7 to 8 to 10 years if they want to exit. And the focus of obviously of the organization is for generations and generations. So sometimes organizations do take decisions, strategic decisions, even to suffer losses or go along with some laggards in hope of generating a good business, strategically at least in the future. But when investors come, they want us to shed off that. They want us to focus on just very, very core areas which are giving the highest ROIs, which are making the marketability of the product very, very positive. And short to medium term focus is really the need of the hour as far as investors are concerned. Therefore, sometimes painfully we have to drop some of the strategic actions or strategic moves that we were thinking otherwise, or at least sort of soften them in hope for them to be brought up again. Sometimes even some product lines have to be dropped because they are at a negative gross margin. In some other areas, some markets have to be vacated, which we didn't want to vacate. So those are realities, obviously. But in the hindsight, if you see, perhaps that's the need of the business. The businesses which is red dotted all the way, all the 10 years we are making huge losses. Perhaps this type of assertiveness, aggressiveness, and this type of cleansing helps us to focus our energies in a very, very core way. Things can happen later. So in the end, it is a win-win situation.
Understood. Anant, my next question is for you. You have a big business on the conventional energy storage side. You're building out your mobility business, and at some point in time, you would raise capital for building the EV battery and charger business. What is the wish list? What kind of investor? So, not what kind of investor. What would you need from the investor, ideally, apart from capital, which everyone brings? Because this is a very evolving industry, and growth could be attained through several different means. So what is it that you would ideally want an investor to bring onto the table?
Right. Good afternoon, everyone. So apart from capital, I think there are a couple of things from the investors. First is the time horizon itself. This is a new evolving industry, and I think whoever wishes to play in this should have a minimum time frame of somewhere between 7 to 10 years story, right? This is not a story which will evolve in 3 years, 4 years, 5 years. We may see a lot of smaller milestones being achieved, but for the story to unfold, I still think it's a 7 to 10 year time frame. Second is to do with I guess I would put it where to play in the value chain. So today when we meet a lot of investors, I think one thing, while everyone agrees that storage and electric vehicles and batteries, these are going to disrupt the electricity and the mobility markets, and they probably also understand the whole value chain, the component manufacturing, the battery, the BMS, or all the way to the front-end businesses. But probably people are not 100% clear on where to play in those segments today, who will be the winners in these individual segments. Is it going to be the battery pack maker, or whether the vehicle guy is going to manufacture the battery? Is it going to be the CPO or the utility in the EV charging space? So my feeling is there is no playbook over here. Like, it's not like some company wants to become another Uber or another Airbnb or another Amazon. In those cases, sometimes the trajectory, you have like a view of a global trajectory, which may not be the case over here. So I think comfort of investors to comfort with partial uncertainty on the timing and the value chain in the sector, and being comfortable with that, and betting on maybe agile teams who they think can make it happen would be my ask, I guess. Yes.
Sure. Building upon that thought, Rajesh and Vignesh, Anant mentioned about several parts of the ecosystem. And when we look at the EV ecosystem, there's the core area where you have the OEs, you have the supply chain participants, a battery manufacturer, a component manufacturer, and then you have the infrastructure owners who could be charger operators or swapping station operators. And then you have the peripheral industries like connected vehicles. Shared mobility is a good end use case. Autonomous driving, though in India that's probably not very relevant today. Do you think some of these parts are more investor friendly than others, or some of these parts of the ecosystem will be looked at more favorably because of their characteristics? Or do you think a holistic investment strategy will probably involve putting in capital on each of these parts to place your bets in a hedged manner?
So I think if I look at the ecosystem today, it's pretty interesting. My view is the whole landscape is changing quite a bit. because of 2-3 aspects. One, obviously, with the drivetrain change from ICE to battery operated is one change. But there is also the change because of the technology improvements on the connectivity side, cheap availability of data, right? Some of the newer technologies like touch screens and ride sharing because of the way shared economy is growing. So you're seeing a lot of changes around these technology aspects apart from the vehicle aspect as well. So when you look at all these together, I believe there will be multiple opportunities across the ecosystem because one cannot look at it as just the pure one EV manufacturer as an OEM, but the allied opportunities which involves the component manufacturers. A lot of patents are being filed for battery motors, the way they operate. So there are going to be unique opportunities on that side of the story. The entire service through the EV system, be it bike taxis, be it the last mile delivery usage, or even the ride sharing mechanisms. And on top of it, the amount of data which is being collected based on the usage of these vehicles is changing. And on top of it, there is also going to be ancillary businesses of once the battery loses its useful life for the vehicles, it still has a secondary life in storage applications, which are stagnant storage applications. The whole financing game is also going to change because today, a significant portion of our two-wheeler in the country is financed. At least 40-50% is financed today. And that's the base vehicle which is getting financed. When you look at the EV, the total cost is upfront because the battery is included there, and hence the volume of financing is going to increase with the EV, right? And the control over the EV in terms of putting geofencing or immobilizing the bike gives better protection to the financier to finance these vehicles. So there is an opportunity to have better control of the vehicle when it's getting financed. And probably the loss ratio would come down. These are early stages, but I'm just giving broad thoughts saying that the ecosystem is changing quite a bit. There will be new business models which will be coming up, and we believe there will be opportunities in each of these, either on a standalone basis or on a combination. So I wouldn't believe only OEMs are the only game in town.
Yeah. So in fact, as earlier Anant made a comment that there's no other models that we can say we are trending towards. So I take it as a good sign, which means we can actually go set up some models ourselves, right? You don't have to be an Uber of India. Like somebody can become something of the US. So when we looked at the whole space, we spent almost a year not only looking at India, looking at what this means, what does EV mean for different people in different parts of the world, because everybody looks up to a Tesla or a BMW and says, that's what EVs are. But actually, no, what mobility means for different people across the world is very different. In India, I'm sure Hero as a company has an experience that when they design a bike, they have to design for 4 people, not for 2, right? Whereas in the US, if you say 2 people ride a bike, only 2 people will ride the bike. So things like that are very different, right? What we see is there's 2-3 areas where we are seeing which are sort of the low-hanging fruit, if you may say. That doesn't mean that other areas are not going to find investor interest. It just means that there are different types of capital coming into different parts of the ecosystem. And we looked at everything from 2-wheeler, 3-wheeler, 4-wheeler, trucks. We looked at Rivian in a big way. We spent a lot of time even looking at flying cars. One of our sister concerns has an investment in an electric flying car, which is actually now started to do vertical takeoff, right? It took 2 years to get to the technology. So it's getting disrupted because, for the first time, the vehicle is forced to be connected. Earlier, the vehicle was not necessary to be connected. Here, because of the presence of the battery and the fuel going with it everywhere, it has to be at birth, congenitally it has to be connected, right? So therefore, you have no other option. The second is that the convergence of energy with the with the OEM is a very important, I think, flip in the mindset. Earlier, the OEM just said, I only have to worry about how my vehicle performs once you've put fuel. And then you can decide which fuel you want to put. You can go to a BP or a HP or a Shell, and the OEM really said, as long as I can work for different fuel grades, I'm good. I don't have to worry about what is the quality of the fuel. Today, the experience of an EV is very strongly tied to how the battery is going to perform. So therefore, the OEMs are having to go that extra mile to make sure that the energy piece is well integrated. And thirdly, I think the data that comes out, because it's both a combination of rapid scale up of deployment across the world and the fact that a full learning cycle is not yet complete, which is very important for financing. Everybody is after the data, right? So we see initial low hanging fruit in where you can do mass deployment, you can collect a lot of data, you can actually help that scale the product development, and that's where the sharing piece, all of those are no-brainers. The one piece that we believe that still is not living up to its true potential is how freight and not just last mile freight but even mid mile freight will transform. Because when you look at some of the numbers on the freight side, it's mind-boggling how much actually EV can disrupt. Today we don't have the product yet, but it's a huge disruptor that can change things for India. So these are some of the low-hanging fruits, but that doesn't mean that the rest of the ecosystem will not get money or does not need money. The one thought that I would leave is to say that a lot of people talk of patient capital, and I think Mr. Gill is right to point out that there's always this tussle between the investor and the entrepreneur, right? To say what is strategic, what is where do we have to give up a little to gain long term, and how do you get profitability? But of late, we are starting to see that even investors are forced to consider, don't just look at things at a 2 to 3 year, because a cycle can actually come and go very quickly. You have to look at teams that can survive 2-3 cycles, and that's the right kind of team to bet.
In that context, the way most businesses have attract capital in India, and if you make a matrix of software stroke services and hardware stroke manufacturing at one axis, and early stage versus mature stage on the other axis, you will have very few businesses sitting in hardware and early stage, and EV probably sits entirely there today. Most of the early stage industries are in software services space. That's a very, very well explored space in India, attracting a lot of capital. So how do investors look at investing in manufacturing businesses, hardware businesses, which are early stage, require patient capital, and also probably require large amounts of capital for scale up?
I think you sort of got to the real core issue, and I think you're waiting for people to get warmed up after the lunch, right? So that people are in the room, and then now you can ask the tough question. I think traditionally India has been great about software, and I think that's sort of been the DNA of investing the last 30 years. People have been able to see the returns. I think what actually helps the EV sector here is India is also one of the markets where automotive development, and particularly in terms of cost engineering, right? And now the new product development is actually quite vibrant, right? Till about, I still remember in the 80s, there were only 3 scooters around. And then now if you look at the 2010, what's available to an average millennial, it's a plethora of options. And some of them are the same platform rebranded, some of them are new platforms. So I think what helps the EV sector in the hardware and manufacturing side is that there is that automotive grade of thinking, if I may call it, which is cost engineering conscious, that is talking about reliability at large manufacturing scale, that's talking about supplier development. Those are all equally key for EV to succeed, right? So I think that gives a little bit of comfort. The second is, a lot of the talent here has actually been involved with fabless in electronic development. While the fab itself has been outside, India has a very strong fabless capability, and I think electronics engineering is something that is traditionally design, testing, as well as rapid product development is something India has been good at, right? So when you look at the EV system, these are all things that have to come together, which is also where we feel that some of the more successful plays going forward will not be pure standalone plays. It will be a charging technology provider coupled with the software layer that runs and optimizes where is the best place to charge. It will be a little bit more vertically integrated OEM as opposed to a pure play OEM. I think those convergence themes are the ones that will actually succeed in EV, and those require more than just one type of skill.
Rajesh, any thoughts?
Yeah, so my thought is, if I take the entire vehicle market, and just the two-wheelers alone is a large market, 20 million vehicles. So the market is large. For any investor, they would like to see the market to be large. And with the changes in the technology and the way EVs operate, there can be niches to be starting with for particular use case. People can start manufacturing products which do not need huge amount of capex, and there are existing component systems available to use the supply chain to develop products for a particular use case and then start scaling up from there. So, and also the whole game on brand development and distribution with access to digital marketing, things have changed. You have seen a lot of consumer brand companies come up with new brands without spending the kind of money what a Levers or a P&G is spending today, right? We are seeing so many of the consumer brands coming up. I think those give the opportunities for many new startups to kind of build brands and products, which we always think in a manufacturing world, only if we are a large company like an L&T or a Hero or a TVS can deliver products and sell to the customers. That's not the case anymore, is my view.
Okay. My next question is relevant both for Exicom as well as Hero Electric. So Anant, maybe you can answer it first and then I'll come to Sohinder. In your spaces, you have a set of new age players who are driving growth predominantly till now, but you also have a set of conventional players. In your case, that would be the Exides and Amarajas, and in Hero Electric's case, those would be the big boys of ICE vehicles, who have probably started a bit late, but from an access to capital standpoint, they might have a little bit of an advantage. So how do you see the industry panning out over the next 3 to 5 years? How proactive do you think they would be in coming up the curve as far as EVs go, and whether an easier access to capital would help them in that?
Well, I'll answer it a little differently. See, whenever a disruption is taking place, even if it's a longer term disruption, what it does is it creates a level playing field again. By level playing field, I mean both the sides, whether it's the incumbent or some of the new startups or some of the new businesses, they both have to invest and learn about new things. So for some of the incumbents, they do have distribution. I don't know how much relevant distribution is in this new sector, but they do have distribution. They have really strong relationships with the OEM. They have a brand, and they have a strong financial balance sheet at least, right? So there are some of the strong points. But then they do at the same time have the burden of the legacy business, which they have to continue, which will probably go through a slowdown if this disruption really happens. And they have to develop totally new technologies for catering to this segment. On the other hand, some of the newer players, such as Exicom or many others, the flexibility we have is no legacy, and we have gone really strong into development of new technologies over the last 2 years, where today we have an edge over others. But yes, we don't have a balance sheet and a brand and an OEM relationship which some of these guys have. So we have to work on these items. The incumbents have to work on the other items. And eventually, I think you will see a mix of players over the next 5 years, which is a combination of some new players as well as the old ones. But one thing is, whenever there is such a massive change, you always see some big new companies emerging. So my take is, if I have to think of 5 big companies in 2025, my guess would be there would be at least 2 new companies who are working in the sector today, and that's we have seen it in every sector. So yeah.
Sohinder, how is it shaping up in the OE space? How is the competition?
See, I've seen all these 30, 40 years of two-wheeler OEMs, all of them. They excel in what they are doing vertically up. They keep on graduating, incrementally adding technologies and coming out one product after another. The whole of the organization is just made for that. That, okay, how to make better four-stroke, how to add more thrust into it, how to do more power and all. In the process, perhaps what is missed out in this organization is nimble-footedness, agility, adaptability to quick changes, and also integration with the systems which are available around in the ecosystem. That's where the other players, even like Hero Electric, new startups, or others, they gain strength. They can get together, they can amalgamate, they can integrate and create a big force, which can give run for money for the big players. So if big players have to enter to the business, they have to vertically draw a line in their businesses. One type of business in the big player has to specifically take care of EV, EV, EV. They cannot be mix of two. While on the network side or on the supply side, there could be some sort of a commonality. But on the culture, on the attitudes, on the R&D, on the amalgamation, there has to be so much of a partitioning in the organization that it becomes quite difficult for any OEM of a very big size to immediately think of quantum jumps in EV. So perhaps I personally believe you will find ones and twos models coming out with such products till the time they find the market is so big, so much turning, that they have to forcibly jump into the business. On the other side are the small, very small players who are doing wonderful job, all startups. They're doing great things like in IPs, patenting, and otherwise creating some distinctions, some small models, whether it is sharing, rentals, deliveries, etc., whatever. And they just lack sort of resources in some cases, or the width of business sense in this case. So such people may not be able to be successful in products. For example, I don't believe many people would come out with a successful two-wheeler or a three-wheeler if they concentrate the way they are concentrating, but they will do a wonderful job in whatever they're doing in smart connectivities or in sharing businesses or in solutions or in distinctions. So after some time, these are available for bigger players or mid-sized players to get together. So the cohesiveness of these type of synergies perhaps will happen in 2 to 3 years' time, where if I don't have smart connectivity, I'll tie up with somebody who has a great smart connectivity. If I don't have a rental and sharing business, I'll acquire some businesses who are doing sharing and rentals and become bigger and bigger. And these type of setups, these type of businesses, when they get together cohesively, it will be a great strength for new players who are still sitting on the fence, thinking when to enter and how to enter.
Yeah, perhaps acquiring some of these businesses will also enable them to keep it as separate entities, which you mentioned, which is probably required to have a different mindset altogether for product development and addressing early needs. Moving on to a very frequently debated topic, the role of government. And when I'm referring to the role of government, I'm not necessarily referring to its role as a policy-making body. Is there a bigger role that the government can take as a financier over and above the subsidies? And I know, Vignesh, you had some thoughts around that, so maybe we will start with you. But are there models where they can also participate in equity raising for early stage companies? Or are there models where they can set up bodies which can do vehicle financing? So are such frameworks being thought about at a government level or among the market participants so that they can speak to the government and build something on those lines?
Yeah, as an investor, it's a topic very close to our heart. So we do have some views. Are there things going on in the government on this front? I don't know. I can't claim to know everything that is there. But have we been knocking everybody that we could possibly get access to at this point to share some ideas? Absolutely. And I think the role that the government plays should be looked in a broader context of looking at how vehicle financing happens. And I think this is something that we've studied a bit, and when we see what's happening in markets across as well. If you look at the vehicle loan business, it in fact is one of the largest sell-down businesses in the entire world. What it means is today XYZ gives you a vehicle loan. Usually within a week to 10 days, they no longer hold the loan. There's somebody else holding that loan. And the reason that has been set up, and it's taken years to get there, is people understand what this vehicle is about, what the brand is about, what it'll achieve, and what is the value, terminal value. And in fact, one of the reasons why Tesla became as successful is because they were able to establish very clearly what it takes for a refinancer to buy a vehicle loan that has been given to a Tesla passenger, a Tesla customer, right? And I think that is something that is very important from a financing aspect for even EVs to take off in India. So what is it that the government can do there? Obviously they can't go and buy out the loans, nor can they give directly loans to the people. But the government is in a very influential position on 2 to 3 fronts. The first is, and I think in a previous panel, somebody was make it simple, right? Don't complicate the issues on what gets subsidy, etc. I think there are 3 or 4 actors who need to be given the support, capital support. One is definitely the people manufacturing the vehicle. The second is people who are using the vehicle. The third is people who are manufacturing or providing services that are ancillary to the vehicle, right? Now, if you end up giving capital type subsidy to just one of the 3 players, then it sort of skews the market, right? Today, in the age of cheap data and the fact that India is actually far ahead, whether it comes to direct payments, traceability, even tracking where vehicles are, and it's fairly cheap technology today. I think one of the things that the government can clearly spell out, which would be very helpful from a financing standpoint, not just it giving money, but in terms of attracting more money to come to the financing this sector, is to say that the subsidy is broken up into pieces that are beneficial for both the manufacturer as well as the user. Now, why is that important? Is because we believe that whether it's a high-end customer or a ride-share customer or a delivery boy who's delivering something on a vehicle, there needs to be some incentive for everybody to keep increasing the usage of electric vehicles, which then directly propels the adoption and therefore benefits everybody in the ecosystem, whether it's a manufacturer or the service provider. And we believe such models are possible today. Maybe it requires handshake between 3-4 different ministries. But if we were to look at a bunch of other ministries or other areas where such data can be put to use to create financing solutions, clearly it is possible for the government to play an influential role here. The second piece is, and it's again a point that we have been making the case for, and this is particularly beneficial for people who are using EV in a commercial use case as opposed to a purely personal use case, is to say that, can the, within the norms, within certain specific norms, can the priority sector facilities be made available? And this is particularly important when you're talking about logistics, supply chain, or deliveries and things related to use of EVs in agriculture. Can this be made available, right? And why is that important? Is because I think the cost of debt is a significant driver in a high capex economy. And if you're able to provide this, over a period of time, you can still phase out, we believe, the capex subsidies for the users or the OEs if it becomes parity. But making such financing lines available is actually a more market-centric approach as opposed to trying to say, can I give an upfront capex subsidy, right? Drive more usage, help that data create more innovative ways of extracting juice out of EVs, and thereby make EVs more relevant for India. I think that's sort of the virtuous cycle the government should try to set up with financing facilities. So direct equity, sure. I mean, we can't decide for the government. The government has direct equity in half the country, right? So we don't need to talk about that. But I think what are the innovative ways that the government can think of doing this? I think there are a few ideas that people can share.
Very fresh insights. We could go on, but unfortunately, we have very little time left for Q&A. So I'll just open up the floor for Q&A. Please state your name, your organization, the panelist who you want to ask the question to, and please restrict to one question. All the panelists are available post the session, so you can catch up with them after the session as well. So we'll take up questions now.
Hi, my name is Aditya, and I'm from Orange Mantra. I would like to point this question to one of the people from the investment side. Just why is it that we in India still file the lowest amount of patents in the world? One of the lowest amounts in terms of our population, in terms of the amount of industries that we have. Why have we not been able to move beyond that? And are we, over the next 5 to 10 years, going to be able to move beyond that and achieve something in that space as well? It does require investment and of time and capital, of course.
Maybe Anant, you can take that up. It's, with some amount of innovative work that you're doing.
Well, I probably cannot give a very broad-based answer, but we are doing some work on the battery side, and at least for us as a company, we are a mid-sized company, and over the last 4 years, probably this was not even the thought process. We could have filed patents, but for some or the other reason, it was not like a sharp focus area. But this year, when we took this whole game seriously, we realized that there are almost 16 patents that we can that we are going to study for. I'm not saying we think we can file 16 patents. Maybe the final result is 10, 12. I don't know. But it's for us, it was just the focus on it, and now focus drives more focus. So I think maybe in 2 years we'll be at a better place. But maybe one of these guys can give a more broad-based answer. This was specific to us.
No, this is a much broader question. Why only relating to EV, right? So the question is, fundamental research in the country is limited, right? The financing available for fundamental research in the country is limited. Who provides this financing? If you see globally, most of them are run in universities through endowments, right? There are not many such endowments in the country. Very few organizations like an IISc or IIT get funded to do core research. So that's not enough. And the government has recently announced, as a part of the CSR scheme, money can go into institutes to do fundamental research, and as that takes off, probably you will see more fundamental research happening and more patent filing happening. But till that time, you should understand India is still a developing economy. It's not even crossed the $2,500 threshold of per capita, so it will take some more time to get there.
Next question, please.
So my question is to Rajesh and Vignesh. On the investment side, Karthik summarized the broad EV ecosystem into 4 broad parts: the OEMs, the components, which is battery, motor, controller. The third is the charging infrastructure, and 4 is the services, which is ride sharing, mind sharing. A quick question: could you rank these 4 in terms of priority, where you would put your bets on, in terms of potential upside in the next 5 to 10 years? 1, 2, 3, 4.
I think our assessment, at least, and I think at least on the 2-wheeler side and 4-wheeler side, it's very clear to us that none of the ride sharing or the shared economy models are profitable without going to EV. Right? I'm just making a bold statement because maybe some will get profitability if oil falls to $50, but I don't know. That's not something we control. So I think in that sense, and I'm talking purely in the context of the EV transition, those areas will benefit, and the software and hardware development towards that, whether it is both in the vehicle as well as the grid. Let's not forget that the grid also requires an equal amount of reboot in some of these areas. Would definitely benefit fastest and the first. I think therefore the OEs have a huge role to play, because if there is no vehicle, there's nothing you can do. We believe financing is a play that is still extremely underserved and underdeveloped. The existing financial metrics that exist to underwrite vehicle loans are going to get upended. It will require you to turn the understanding of what a vehicle does and what it should be paid for on its head. And I think that's the third piece that will get disrupted.
Rajesh, you want to take a shot at the answer? I was trying to come to a brief answer because I think it's a very complex ecosystem which we are in. And there's a lot of interdependency, right? I mean, a part of the EV two-wheeler growth is obviously dependent on how the ride-sharing model succeeds, because we're not seeing consumers lapping up two-wheelers very fast, right? So there would be a shared economy or kind of a codependence. But
no, I would say the pecking order would be the service providers, which is the guys who are giving the ride-sharing services, and the OEMs will be the pecking order for me, because the OEMs will also have a play. And my belief is the government has to do a lot more in terms of making a lot of the public fleets more electric, as well as in terms of the buses. While it may not have the ROI, but those are the investments which the governments have to make. And even in PSU, you could say that the entire Amul's distribution should be electrified over a period of time. So some of those things can be taken up by the government. So I would say the OEMs and the ride-sharing guys are the pecking order top for me, and then the balance would come in.
thank you.
Any other questions? Great. So thank you so much, gentlemen, for joining me for this session. Hope we could build in some new insights into investing in EV, and all of us are available post the session as well. So in case you want to catch up with anyone. Thank you so much.
Thank you.